$26.5 trillion lie has made Elon Musk the world's first trillionaire. And it is right there in the prospectus Musk filed for the IPO of his AI and space tech company, SpaceX. Musk claims that the total addressable AI market is that fabulous figure I just told you, $26.5 trillion. And according to him, this excludes China and Russia. $26.5 trillion, that's nearly 90% of America's GDP. It is about a quarter of the world's GDP if you exclude China and Russia. A quarter of the total income of every person and every business on the rest of this planet. No wonder Aswath Damodaran, the man Wall Street calls the Dean of Valuation, has called this a hallucination. Something that we know AI is great at. This hallucination, this delusion, this lie of AI's market size is the reason why all the money in the world is chasing AI stocks right now. It is the reason why the world's biggest tech companies are investing hundreds and billions of dollars into building AI tech. The danger is not only that they're pumping good money into what could well turn out to be a bad business. The danger is also how they're doing it. A single word describes it: debt. Because as I will show you in this video, big tech has actually quietly run out of cash. Google has been forced to go to its own shareholders begging bowl in hand for the first time in many, many years. And the big dirty secret, as I will show you by the end of this video, is how $1.8 trillion worth of debt and liabilities have been hidden away from the public eye. $1.8 trillion. And no one is talking about it. This debt bubble reminds me of the home loan bubble that took the world economy down 18 years ago, what we call the global financial crisis, from which frankly we still haven't really recovered. It is the reason why this AI race carries the very real danger of becoming our problem, yours and mine, and not just a problem for those who have invested big money in these companies. This is not just me ringing alarm bells. The warning has come right from the top of the world's financial regulatory chain, from the Bank of International Settlements, or BIS. It's a sort of central bank of central banks, which every nation's central bankers listen to. The BIS has just said that the rush to invest in AI infrastructure resembles mega bubbles of the past. The canal mania in the USA in the 1830s, the British railway bubble of the 1840s, the electrification exuberance in the 1920s, and the dot-com bubble of the 1990s that burst in early 2000s. Each of these began as investment into real useful technologies, but it soon led to overinvestment, constructing more canals, laying more railway lines, or building more power lines than the underlying business ever justified. And when each of these investment cycles eventually collapsed, they didn't stay just restricted to just canals or railway lines or defunct websites. In each case, the contagion spread and affected everything across the economy. That is exactly what the BIS fears could happen with the AI race as well. I've gone through the 33-page annual report that the BIS released a couple of weeks ago, and I've also studied pages and pages of the financial reports, filings and announcements of the top tech companies and hyperscalers, and I have read the vast coverage of the AI ecosystem by the world's top financial analysts. I've spent time on this over the last week. And that's why I decided to do this video, because the picture is really scary. But before we dig deeper, give me a minute to quickly explain why the AI business is different from all the tech businesses we have known till now. AI, as you know, is artificial intelligence. It's meant to assist and ultimately replace you and me. Right? Before AI came into the picture, you would use the biological computer in your head to type out an email. Nowadays, it is much easier to, frankly, ask ChatGPT or Gemini or Claude to do it for you. Compare the computing power required for the two processes. If the computing work your laptop did when you typed an email entirely on your own was like taking 1 millimeter step forward on the surface of the earth, then the computing work needed to train an AI model and get it to write that same email for you would be like walking across the entire planet. That is the difference in scale. You can look at it in another way. A mega data center that provides cloud computing services to AI companies uses the same compute speed and memory as millions of high-end laptops running simultaneously. And that is just the cost of chips, by the way. Then comes the cost of the buildings that house the chips, the massive amounts of electricity needed to run them, the billions of liters of water needed to cool them. It is a scale of infrastructure building that has never been seen before in the history of capitalism ever. It is completely different from the software revolution of the past decades, which was largely about humans sitting and writing code. That's why there's this mad rush among big tech hyperscalers and the big AI companies to invest in data centers and in the computing power required to build their AI models. The BIS report I talked about says that just the top 5 hyperscalers, Alphabet, Amazon, Microsoft, Meta, and Oracle, that provide cloud computing services, are spending a total of $1 trillion on AI-related capital expenditure from 2025 through 2026. That is almost the same as the total capital expenditure of all the non-technology companies in the S&P 500 put together. That's a group of some of the most valuable companies, not just in America, but across the world. And by the way, $1 trillion is 1/4 of India's GDP. And that's being spent by just 5 hyperscalers on AI infrastructure. Now, that wouldn't be a problem if these AI companies made enough revenue from selling AI services or had a lot of cash reserves. But do they? Let us look at the cash first. And here's the most worrying part of this entire story. The case of Alphabet, the owner of Google. For more than a decade now, it has been the most successful internet story of all time. It made pots and pots of money and built a treasure chest of cash. So much cash that for the past several years it has been giving it back to investors by buying back shares from them. But in the first quarter of this year, Alphabet's free cash flow, or the money left behind after all expenses and reinvestment requirements have been met, that fell by 47%. That's why for the first time in 11 years, Alphabet, aka Google, skipped its share buyback plan. And then in June, it did something it hasn't done in a long time. Instead of buying back shares, it asked shareholders to buy more of its equity. $80 billion worth of it, to buy more AI hardware. If this is happening to the parent of Google, then obviously other hyperscalers are not immune to this cash shortage. For instance, Amazon recently reported that its free cash flow fell 95% compared to a year ago. 95%! Another hyperscaler, Oracle, has reported that its cash flow is a negative $25 billion, as it is burning through cash to build data centers. UBS, one of the world's largest wealth management firms, has estimated that hyperscalers will spend 100% of their cash flow this year on AI capex. Compare that to their average capital expenditure over the past 10 years. It was just 40% of their free cash flow. So, the cash is running out. But surely you would say revenues from selling AI services will come to the rescue, right? Let us work that out with a simple formula. In September 2023, David Kahn, a partner at Sequoia Capital, which is arguably the most famous venture capital fund in the world, worked out the bare minimum revenue the AI ecosystem needed to generate to pay for the massive investments in building AI infrastructure. Kahn argued that the cost of building and running a data center would be 50% the chip hardware and the remaining 50% electricity and other operational expenses. Since NVIDIA was and continues to be a virtual monopoly in providing chips to data centers, whatever hyperscalers spend on chips would be exactly the same as NVIDIA's revenues from data centers, right? So let us take this formula and work these numbers out for today. In 2025-26, NVIDIA's data center revenues were about $194 billion. Double that to get the cost of running a data center, that's $388 billion. Now, Kahn's model assumed that hyperscalers sold cloud services to end users like OpenAI and Anthropic at cost without making any margin in it. So, end users would have to spend $388 billion on just cloud services, and they would need twice as much in revenue to have a 50% margin to pay for other expenses and to make some profit. That is $776 billion. Mind you, this assumes the hyperscalers themselves make no margin at all. But hyperscalers are businesses, not charities. give them the same 50% margin, and they themselves need 776 billion in revenues, which now becomes the cloud services cost for the end users. Repeat the process of doubling it for margins and you discover that the revenue the AI companies need to generate is a whopping $1.5 trillion. That's a lot of money, but not impossible to make, right? So how much are these end users of AI data centers actually making? The largest AI company, Sam Altman's OpenAI, had a projected revenue in 2025 of just $13 billion. Anthropic's was just about $5 billion. Even if they were to increase that tenfold this year, they wouldn't even make $200 billion between them. And what is needed right now is 7.5x that amount, $1.5 trillion. So it is clear that no one in the entire AI ecosystem can actually generate enough cash to pay for the race to build AI infrastructure. So if the AI ecosystem is running out of cash, how is it going to fund this crazy growth in investments? One route, of course, is selling shares. And they're doing that by the fistfuls. SpaceX has just raised $75 billion through its IPO. Alphabet, as I said earlier, has raised $80 billion by selling shares. Anthropic and OpenAI sold shares and raised $187 billion between them. And they are also planning their IPOs later this year to raise another $60 billion each. So all the cash flowing about in the world is being sucked up by these AI players. But it is clear that selling shares isn't going to be enough. So they are also borrowing hundreds of billions of dollars. In 2025 alone, the mama hyperscalers, Oracle, Microsoft, Alphabet, Meta, and Amazon, together issued bonds worth more than $120 billion. And this is expected to rise significantly in 2026. In fact, JP Morgan estimates that over the next 5 years, the AI ecosystem will issue bonds worth another $1.5 trillion. For those of you who don't know what a bond is, it is just another word for a loan with a fixed maturity period and regular interest payments. The only difference between your fixed deposit and a bond is that bonds can be bought and sold. So why should that be a cause for worry? After all, companies do borrow to expand their businesses and then they pay off their loans by making big profits. Two things. First, Finance 101 tells us that a business that doesn't make money shouldn't borrow. Instead, it should rely entirely on selling shares to raise capital. Why? Because you have no obligation to pay anything when you sell a share except to give up a part of your ownership. The risk of failure is entirely borne by the person who bought your shares. A loan is very different. Whether you make a profit or not, you have to make regular interest payments and you have to pay the principal back once the loan period is over. So if the AI ecosystem fails to make money soon, it will fall into a sort of debt trap where the companies will have to take more loans to pay back the old loans. Because once it becomes clear that the businesses can't make profits, no one would want to give them money in exchange for the shares, right? The second big danger is that most of this debt is coming from private lenders, who in turn are raising cash from big insurance and pension funds. Private lenders are not regulated that much. Their transactions are opaque, and if a problem develops in the system, it could easily and quickly balloon into gigantic crisis before anyone would know about it. At the same time, private lenders are also very fickle. They try to get out as soon as there's any sign of trouble in the system. History tells us that when a regulated bank collapses, the entire system shuts down. And that happens despite the fact that banks are much more stable than private lenders are. So just imagine what could happen in this opaque, unregulated space of private lending if something happens in the AI lending space. Any crisis would spread like COVID across the financial system, taking everything down with it. Some argue that these AI giants are so big that the US government will not allow them to fail. So if they don't make money, if anything happens, they will be bailed out by the government. But this debt threat is not just restricted to big tech. Smaller engineering and construction companies, which are building the data centers and helping to run them, are also borrowing heavily. No one will come to save them if the entire AI loan bubble begins to burst. In fact, somewhere inside this hides one of the biggest dirty secrets of AI financing, the $1.8 trillion that I spoke about right at the beginning of this video. That is Morgan Stanley's accounting team's estimate of committed future liabilities that AI companies have signed up for, but which are not showing up as debt on their books. Let me explain and break this down a little bit, how this trick actually works. The first part of it is leases. AI companies have signed long-term contracts to rent data centers that smaller third parties are building for them. Now there is this loophole. Under accounting rules, a lease enters a company's balance sheet only when the building is handed over and the lease actually begins to operate. Until then, these tens of billions of dollars of promised rent sit quietly in the footnotes of annual reports, where almost nobody looks. The company has committed the money, it is legally bound to pay it year after year for a decade or more. And because it is a long-term legal commitment, unlike a rental you can walk away from, many analysts, such as the same Aswath Damodaran I mentioned at the beginning, consider leases to be no different from debt. But on paper, despite the promised lease payments, the hyperscalers look debt-free. The second part of this dirty secret is binding purchase contracts with chip makers. These are take or pay deals. The AI company must pay for the chips whether it ends up needing them or not. And these two are not counted as debt. They are labeled purchase obligations and tucked away in the fine print. Add the two together and you get Morgan Stanley's number. $1.8 trillion of debt and liabilities owed to the future, hidden away from the public eye. It is like judging a family's finances by only looking at its bank loans while ignoring the fact that it has signed binding agreements to pay rent on 3 houses for the next 15 years. The family looks solvent until the bills start arriving, and it gets worse. Even the BIS says that the transactions in the AI world are so poorly disclosed that AI companies are getting away with pledging the same assets multiple times to raise money. It is like you taking out a loan against your home by pledging it to multiple banks at the same time. If the AI industry doesn't start making big money soon, this debt-fed bubble is bound to burst, and it will unleash the mother of all global recessions. Then, just like it happened in 2008, you and I will also pay for it with our jobs, our assets, and our savings. The problem is that despite warnings from many people and past experiences, regulators aren't really doing anything much about the shady side of AI financing. These opaque circular transactions shouldn't surprise anyone who has studied the world of AI financing. It was already exposed by analysts last year. I traced that loop deal by deal, dollar by dollar in the video on your screen right now. It explains in great detail how the AI Ponzi scheme, the entire game of AI, really works.